See everyone jumping on. Hopefully you can hear me and see me properly and see my screen here. So today I'll be talking about the 10 money mistakes high earners make. My name is Aaron Fragnino. I'm one of the co-founders of People's Capital Group. We do these master classes, these passive investor master classes every single month, usually at the last week of the month on generally, Thursdays at 3 p.m. on last Thursday of the month. So what we aim to teach at these classes is how accredited investors and high net worth individuals and family offices can preserve their wealth and build their wealth primarily through real estate. We focus on a new topic every single month, and a lot of the topics revolve around real estate, IRA, self-directing their IRA, tax strategies, and New Jersey market expertise. Our last masterclass was about the lazy 1031, which is pretty interesting. We had some great feedback from that one, and if you'd like a copy of that masterclass from December, just shoot us an email at info@peoplescapitalgroup.com, or you can reply to the email you get for these master classes here, and we can send you a copy of those past classes. Before that, we talked about the 4 cycles of the real estate market. So that was exciting as well. We talked about where we are in that market cycle and where we're likely heading. So that was in November. But today, our January masterclass is called The Top 10 Money Mistakes High Earners Make. So let's get right into it. Quick disclaimer here, this is not a solicitation for funds, tax advice, or legal advice, but we are going to go over the top 10 mistakes high earners make with their capital and how to avoid those, and also how to protect your capital as well. By the way, if you can't hear me properly or see my screen properly as we're going, just write in the chat, the Q&A. I also encourage questions in the chat. No such thing as a stupid question, so please put your questions forward here, and I'll answer all questions at the end. I encourage interaction and questions as we go along here. Here's a little more information about us here, People's Capital Group. We've been helping people build and preserve their wealth in passive real estate investment opportunities over the last decade, really more than that, since 2013. So we're located here in Somerville, New Jersey. We focus strictly on the northern New Jersey market. We buy vintage multifamily properties. The vintage means older assets, generally built in the 80s or earlier, that are mismanaged and rents 15 to 30% plus below market value, often deferred maintenance. And we renovate these assets with our in-house property management company. We have over 100 investors that participate in these opportunities, and they earn quarterly cash flow when available and large distributions upon the refinance and sale of these assets as well. So if you want to learn more about qualifying to get in on our opportunities, I'll touch on that in the very end, but we'll get into it here on the top 10 money mistakes accredited investors and high net worth individuals make. So first I'll go over the top 10 mistakes, then I'll talk about how to avoid these mistakes, and also how high earners can pay less taxes and keep more of their hard-earned money. I have never met anyone that likes paying taxes, so we really help our investors strategize how to pay less taxes. That's a big strategy, a big reason people diversify into real estate is to keep more of their money and pay less of it to the IRS. It's one of the most beautiful things about real estate. That's why I love owning real estate as well. And why even the wealthiest individuals still make money mistakes. We'll touch on that as well. So our top 10 mistakes that high net worth individuals make. First of all, what we've seen a lot of is actually no emergency savings or limited emergency savings. Now that might not make sense, of course. Why would a high net worth individual not have enough emergency savings? So what happens here is you create a lifestyle that is extremely expensive because your earnings are strong, and something happens, a loss of a job, a health situation where you can no longer work or operate your business, or the loss of an asset that wasn't properly insured, which is our next thing here. Something happens where the wealth situation changes drastically, a divorce possibly even as well, and the high cost of living is still there. The car payments are still owed on your Ferrari. The mortgage payments are still owed on your 3 beach houses. Maybe you over diversified into a high risk investment or a new business opportunity that you felt excited about, or cryptocurrency, or something that didn't pan out as you had planned and lost capital. Or you're just over invested in multiple investments, which is actually much more common with high net worth individuals and high earners. Over investing in illiquid investments and not keeping enough emergency savings, and also building a lifestyle that perhaps is quite expensive and not keeping up necessarily with their income. So we want to make sure we have a balance there as well. Secondly, not having enough insurance or the wrong type of insurance, or not necessarily having the right things insured with your assets, the right situations insured. Right, we all saw what happened with the big fires recently in Southern California. Tragically, a lot of people lost their home. Some people even lost their life. And you not having your home properly insured, or not having the right type of insurance, can lead to a loss on your investment. One of the things that we like about real estate is that you can insure it against loss. For example, I had a property that was struck by lightning. I think it was like 4 times or something like that. It was struck by lightning and caught fire. And we did have the right type of insurance, and we had plenty of coverage because we always kind of over cover our properties. So we might even pay a little higher premium because we have very good insurance and a lot of coverage. But you want that because in the long run, if something happens to your property, you are covered. And what happened with that property is we made out very well. There was some fire damage to it. We sold it to a contractor for a good price. We were able to cover the debt and sell it to the contractor for a good price. It pocketed a little bit on the sale of the asset. And then we just pocketed the insurance payout, which was a lot, which was more than enough to renovate the property. And we decided not to renovate the property, right? We decided to sell the asset, cover our debt, make a little on the sale, and then pocket the insurance payout, which ended up being far more lucrative than if we had just sold the asset, as a before it had gotten struck by lightning, right? So, um, now, not all scenarios work out like that, right? We've had scenarios too where there's been flooding in properties that are not in flood zones. Now, flood insurance is extremely expensive, and there's no reason necessarily to get flood insurance for an asset if it's not in a flood zone. But I forget the exact name of the hurricane, but it was the one that just had dumped a ton of rain, maybe 4 years ago, I want to say. And one of our assets had flooding in the basement. Now, the key is when the insurance inspector comes through, don't say the F word, flooding. But they caught on that, of course, there was flooding in the basement, and that destroyed about 11 boilers. So we had to replace those assets. Now, luckily, we bought the property at a great price. We had reserves on the property as well, and we had a lot of equity in the property. So we were able to fix those boilers and then complete our repositioning and then refinance the asset. We achieved about a 22% annualized cash on cash return. We returned about a 45-50% of investors' capital in about a 2-year period on that property. So we certainly ran into headwinds there, but luckily it was a property we bought for a great price and ended up panning out nicely for the investors there. But bottom line is you want to have the right insurance. You want to overinsure. You want to work with good insurance agents that are going to guide you properly in that insurance process so that they're not just selling you the cheapest insurance, that doesn't cover all the issues. Where you want to think about what happens if your tenants have to be displaced, right? Is there coverage for that rental income? That's a common thing with multifamily property. What is covered? Fire, hail, storm, wind, flood, water damage. Water damage is rarely covered in flood in insurance. You have to get additional insurance called, flood insurance to cover water damage. So does that make sense or does not make sense, right? And sometimes if you're not in a flood zone, then it's very unlikely you actually get flood insurance. Also not updating your will, right? As your wealth grows and your investments change, so should your will. And I'd say I'm probably guilty of this too. Right? Not updating your will properly as your wealth grows, especially if you're running a business like I am, or so you're buying, a lot of family offices I know are getting new assets all the time. All right. Every single month or so, they're making new investments. They're selling investments. So you probably want to review your will at least on an annual basis with your state attorney and make sure your will takes into account all of your assets and make sure it's going to the right people and nonprofits or whatever it is, because those relationships might change or whatnot, or different scenarios. So you want to make sure you're updating your will on a consistent basis. I'd say taking a look at it every year is probably a smart way to go, just to make sure it's including all your assets. And also, if you do pass away tragically or quickly, you want to make sure your will is a blueprint to all of your assets as well, because the people in charge of distributing that wealth after you're passing away or so would be using your will as a blueprint. So it should identify all your assets, and by having that properly updated, it'll be easier for your heirs and estate attorney and so on to figure out what is distributed where and how it should be distributed. If you don't do that, then the government will do it for you. So, no prenuptial agreement. This is a big one. Yep, learned this one too personally. So, this is a tough one. Marriage is a major life decision, often cluttered by emotion. And it's very easy to think, of course, you're never going to divorce the person you're madly in love with and about to get married to. It's a very difficult conversation to have with your future spouse. But if you are a high net worth individual or high earner or family office, of course, you've probably already been told this, but you get a prenuptial agreement signed. And if your partner is not willing to do that, well, that might be a red flag, but also understand the needs of the partner, right? I mean, a prenuptial agreement doesn't block your partner from ever getting a dollar from you. There should be some give and take, right? How much would be owed to that partner upon a divorce? Is it a formula based on how long you've been together? If you have children together, right, then it's only fair for that partner to receive some of your wealth, right? But how much is that, right? And what's a fair number? It's a terribly difficult conversation to have. It has probably led people to call off the wedding. In fact, I know one family office that delayed their wedding for months, if not a year or so, because the prenuptial agreement could not be agreed to. So this is not an easy one. Increasing your insurance, you call up your insurance agent. Updating your will, you call up your estate attorney. No emergency savings. Well, have a little more liquidity in the bank. But boy, this one's the hardest one on the list, I think, by far, to actually implement in life. So if you're already married, well, good luck. If you don't have a prenuptial agreement, talk to your attorney about that. There are post-nupts, but I'm not sure how powerful those can be. Overspending and not paying attention. Here's the fifth one on this list. So celebrities are especially known for their growing their lifestyle to kind of keep up with the Joneses, and they grow their lifestyle faster than their wealth. So don't lose track of your expenses just to show your wealth, right? I mean, the most wealthy individuals that I know are don't really show it off, and that's what's incredible about true wealth. You get to a certain level of success where you don't have to show it off, right? You don't need to necessarily tout your success, and that really is true success, perhaps. So don't overspend, don't overindulge. And, there is a value to living a more modest lifestyle. I'm not saying force you to live like a monk, but Warren Buffett's a great example of this, right? He has a somewhat modest home in Kansas. I think it's a perfectly large size. It's a nice home, but he doesn't overindulge. And look where that's gotten him in life. So, having that mindset of not overindulging and wasting money, and God forbid something happens to your wealth or yourself or your health, your ability to earn, you want to be able to have a lifestyle that's affordable in good times and bad. Okay, let's continue. Top 10 mistakes high net worth individuals make. So making bad investments. All right, everyone makes bad investments. I invested in cryptocurrency, not knowing what I was investing in. Bought a bunch of altcoins at the height of the market a few years ago, before the crypto winter, and I invested through the Voyager app. And I didn't understand that if the app you're investing through files bankruptcy, there goes your investment. And I broke my cardinal rule. Don't invest in assets you don't understand. That's exactly what I did. And I lost a fair amount of money. It wasn't a terribly large amount, but I lost a good about $35,000 or so investing in altcoins and not understanding them through an app that eventually filed bankruptcy. And that was a very disappointing experience, but I learned a lot from it. And I mean, I vet my real estate investments meticulously. We have a due diligence firm that is just incredible with the amount of due diligence they do. I was just picking through one of our models, and it's ridiculous the amount of in-depth analysis we do to buy an asset in real estate. And but with our own money, sometimes we are a bit more bold and perhaps I guess the word would be stupid. Yeah. I mean, sometimes we make mistakes. We make mistakes. So vet your investments well, diversify, and do your due diligence on any asset. You'll still make some bad investments over time, but ideally investments that are not complete losses. And the more you invest, the more you learn. And the more the experts and operators that are experienced that you work with, the better your investments ideally should do. Making your finances too complex. This is something that I've seen maybe a little more on like the millennial side, making our finances too complex. And that happens as we start to invest in more and more assets, different types of assets, different operators, different currencies, different locations, right? Your taxes get more and more complicated. And listen, it's tax time now, right? We're talking with our attorney, our accountant, our bookkeepers. It does get more complicated as you build more wealth. There's no doubt about it. Now, as we build our portfolio to larger properties with more investors, more LLCs, it is complicated. I think I have about 35 LLCs, we're about 23 different properties. We have a debt fund, we have operating companies. So we have investors, we have preferred rates of return and waterfall spreads. So it gets complicated. And you want to try to keep things as simple as possible. Now, unfortunately, a lot of good investments are a little complicated, right? You're buying equity in a company or real estate, things like that. So complexity is not a necessary evil of sometimes wise investing, but you want to balance the two. And keep in mind, complexity increase costs and risk, but also, cost because you have more attorneys and accountants and you need more of their time and wealth managers to understand complex investments and maintain them properly, and report back properly. Thinking your income will always be there. This is certainly true for high earners, C-suite executives, and business owners, right? I'm certainly guilty of this too, thinking that, we're always going to be capable of working. It's tough. I'm in my mid-30s. I'm thinking, of course, I'll be able to get up tomorrow and run my business and do what I need to do to continue earning for myself and my family. But the truth is, things happen, right? There's health risks. There's other challenges you can have in life that will lead you to not be able to work possibly or work the hours you need to continue to be a high earner. A lot of our investors are C-suite executives that leave the house at 6:30 in the morning and don't get back till 8 o'clock at night. And that's a heavy life. That's a hardworking life. And I know that life. So it is something that you have to be healthy to be able to do. And you're just not going to really be able to do it your whole life, right? So you want to understand, you want to invest and save as if your income will not always be there and you will not always be capable of working. And that's about really investing wisely and putting more money away and not spending it all on their lifestyle, of course. Over diversifying into risky investments. So this is similar to bad investments here, but this is a little different in the fact that you get excited about something, right? And I did this with my cryptocurrency story, right? You don't want to over diversify into risky investments that you don't fully understand, or you get excited about them. It's the next greatest thing since sliced bread, and you're going to pile into it and double down. Everyone makes those mistakes. And sometimes it can pay off, right? And when it does, it's almost even worse because you're like, oh, I was right buying those meme coins, and you put another 100 grand into it, and then it really, you lose it all, so you want to understand and not over diversify in risky investments. Diversification is good, right? A lot of people say, 5% in crypto, something like that makes sense in higher risk investments, but balance risk and reward when investing. Venture capitalists, they'll invest in 10 companies, expect one to do really well, three to do just average, and maybe three to lose money. And the difference to really just kind of maybe do a small loss or break even. So it's all about diversifying, right? You're not going to put all your eggs in one basket. That's a poor way of investing. And finally, not changing the asset allocation as you age. So generally, a lot of our investors tend to be between the ages of 35 and 55. Our investments are generally 5-year investments. They produce returns, target returns between 14 to 20% internal rate of return. They're not strong on the cash flow side, but they tend to be stronger on the equity side, meaning the return on investment is normally realized upon big liquidity events, the refinance or the sale of the asset, over a 4 to 5 year period. So it wouldn't be great necessarily for someone who's 80 years old. Right? Someone who's at that age really needs more income focused investments, right? Hopefully by then they've done their equity investments, grown their wealth, gotten the high returns, and now they can invest in investments that kind of just push off a nice coupon, maybe a 4 or 5% a year. So make sure that you are investing properly for the time of your life that you're in. Older age requires different asset allocation that's often more income focused to ensure you have enough consistent liquidity for retirement. Younger age is generally more equity focused, where you're just building your wealth as aggressively as possible while being smart and diversified. But you're going to be a little more aggressive before the age of 65 on your investments. You're going to invest in longer term, more equity positions, ideally. And then after the age of 65, investors start to funnel into more income based, safer investments as well, less volatility. So, how do we avoid these mistakes? Well, obviously, I'm sure plenty of you know this, work with experienced professionals. Work with highly referred financial and estate planners, registered investment advisors, and operators. We know some very good RIAs. If you're looking for a good RIA to work with your stock portfolio, reach out to us. We work with some great registered investment advisors, RIAs. Financial planners, right? You want to work with people that understand your financial needs. They not just selling you, their book of products, but actually listen to what your needs are. And if they don't have it, they'll tell you. A good financial planner will say, you need X. I might have that in my toolbox. I might not, right? Because financial planners are only allowed to sell the products their company allows them to. So understand that and work with one that really understands your needs. Again, we know good financial planners as well. If you're looking for one, reach out to us. Estate planners. These are generally attorneys that will be able to guide you in your estate structure, making sure that you have enough money for retirement, making sure your assets are protected, your will is updated, you are properly insured all around, and that helps you to live confidently as you age and have a plan for your investments and your heirs as well. And operators, right? So real estate operators are a great example here. People's Capital Group, we try to be extremely transparent with our investments with monthly updates and quarterly financials. We find off-market deals where investors can earn returns that are generally greater than some of the more average returns, say mutual funds or so, and allows them to diversify into real estate where there's a lot of tax benefits, consistent cash flow, and large distributions upon liquidity events like refinance or sale of these assets. So real estate's a very common asset class, alternative asset class for people to diversify into. And you want to work with operators that source great off-market deals that you couldn't find that are not just sitting on the internet. Generally, vertically integrated operators are good, meaning they have in-house property management. They have boots on the ground so they can manage the assets closely and well and know that market like the back of their hand. and operators with a track record that have been around a while and not just pop-up companies. You generally want to see minimum, 5 to 10 year track record for operators you're working with. So these could be people that are operating businesses, operating real estate, and alternative investments that allow you to earn better returns than, say, mutual fund investments, more common investments you can kind of do through a regular TDA Ameritrade account. Although it's good to have both, right? You want to have common investments in the mutual funds, ride the S&P 500, but also diversify into other asset classes as well for true diversification. Most importantly, also plan and then implement, review, adapt. The word adapt there is very important, and repeat. So create a plan with your selected professionals and implement the plan over time. Review the results. If your financial planner or your operator can't tell you what the results are on your investment, then they're not doing their job right. And you want to work with people that can tell you what the results are and how to improve those results and how to adapt your plan and update your plan and update your investments over time due to changes in law or changes in the market, which are constant. And as you adapt your financial plan, you then want to repeat and continue to invest, plan, implement, review, adapt, and repeat. So continue to build your wealth there and adapt as you age as well. Okay, let's break into preserving your wealth. And I see more people jumping on here. If you have any questions as we go, feel free to put them in the chat there or the Q&A. So keeping your money, right? We all like to keep our money, not give it to the IRS, at least I do. And one of the ways to do that, I read the book Rich Dad, Poor Dad when I was graduating college, 2009. I was graduating Rowan University, which actually just a couple of years ago went back and wrote and taught a course called Real Estate Entrepreneurship, which was a great experience. Really enjoyed it, learned a lot through it. And it was nice to go back and teach a course at the college I had graduated from. But I read this book, Rich Dad, Poor Dad. If you haven't read it, check it out. You've probably heard of it. It's an easy read. You can read it in like 2 days. It's practically a children's book. It's very easy read. And what they teach is paying yourself with the bank's money. And I didn't really understand it at first, but I read this and it changed arguably my trajectory in life. And I said, I want to be a real estate investor. And I made a list at the top. I said, in 10 years, I want to have a net worth of $1 million. And I want to have a cash flow of $100,000 a year. And I worked backwards from that goal. And I said, okay, I need to learn the industry, make money, make connections, learn how to transact real estate and how the real estate industry works. And I said, okay, I'll go get my real estate license. So I started as a realtor in 2010 and learned the industry that way and made some commissions and invested a little bit that way and started meeting investors and raising capital and started a real estate networking group called New Jersey Real Estate Network. We have about 5,000 members in today. Started raising capital that way and buying bigger and bigger properties. Teamed up with my business partner, Seth Martinez, in 2013, who I also met at real estate networking events, and developed a management company in 2015 as we built our portfolio. But we always kept that mindset of paying yourself using the bank's money. And we love to refinance our assets over time so our investors and ourselves can harvest equity growth without paying taxes and deferring our taxes. So the way this works is you pay yourself using wise, leverage backed by strong assets that grow in value, such as commercial real estate or low risk stock position or bonds. So in our case, we buy an apartment building for a discounted price. We renovate the units as tenants move out. We implement amenities into the building, and we improve the revenue on the building and ideally improve the operations as well and lower our operating costs. So we increase the net operating income. As we do that, we build the value of the asset. We force value into the asset by increasing the NOI. Over about a 3 to 4 year period, we then go and complete a refinance. With that refinance, we're able to harvest our equity growth, and we generally target 50 to 80% of our investors' capital back within that 3 to 5 year period through the refinance. Now, as we refinance an asset and we put cash into our investor's pocket, our own, at that point, that cash into our pocket is non-taxable liquidity event. And why is it non-taxable? Because it's debt. It's good debt backed by the asset that the tenants will pay down for years to come. The bank's not going to let you take on more debt than the property will qualify for based on its debt service coverage ratio. But it's debt that is you're allowed to use to harvest the equity growth in your asset, put cash in your pocket, and the IRS does not tax debt. Now, if you sold the building, you would be taxed. If you earn cash flow on an asset, you might be taxed, or they use tax depreciation to write that off. But as long as you refinance the asset on a continual basis, say every 5 years, you can harvest the equity growth in the property and not have to pay taxes. Now, there's other ways to also avoid tax. When you go to sell the asset, you could do a 1031 tax exchange. You can also do a lazy 1031, but that was our last masterclass last month, so we won't get too much into that. If you do want to learn that one, shoot us an email, info@People's Capital Group, and we'll shoot you a copy of that last masterclass. Self-directed IRA. Right, self-directed IRA is a great way to build tax-deferred wealth, or in a Roth case, tax-free wealth. So with a self-directed IRA, you work with an IRA custodian. There's dozens of them out there. We like Madison Trust. We like Next Generation Trust, Equity Trust. And these IRA custodians, it's generally about $100 to $300 to start an account. And they'll contact, once you start an account, they'll contact whoever holds your IRA, say Fidelity, and they'll say, okay, you want to move $100,000 into an investment with People's Capital Group. So your IRA custodian will contact Fidelity. They'll move $100,000 from Fidelity over to the IRA custodian. And then the IRA custodian will review the investment opportunity that you want to move it into. Now, your IRA custodian will not tell you if it's a good investment or not. They're not like a wealth advisor necessarily. What they do is they tell you if you are able to legally self-direct your IRA into that investment. There's certain restrictions. You can't pay for your child's college education. You can't buy a beach house and take your family there for free. But you can invest in passive real estate opportunities. You can invest in your brother's business. Okay, you can't invest in your son's business or your grandpa's business, but you can invest horizontally on the family line. And your IRA custodian will guide you in this process. That's essentially what you're paying them to do. Also, to be a middleman and protect you from violating the IRA rules. But then when you invest in an asset, say apartment building here at People's Capital Group, when you earn quarterly cash flow distributions, those distributions go back to your IRA custodian to build your IRA. Then we have a liquidity event like a refinance or a sale. Those big liquidity events go back to your IRA custodian to continue to build your IRA. You could do a Roth IRA or traditional. There's differences between the two. We won't get into that too much right now, but using a self-directed IRA or just your IRA in general is a great way to defer taxes and build your wealth exponentially. And tax depreciation. So finally, this is a great way to utilize the tax code and use the incredible tax benefits, primarily in real estate, although you get tax depreciation with other assets, but real estate is the most popular one that produces arguably the most tax depreciation. You know, one of the things we do when we buy an asset, now we do something called a cost segregation study. And if you're buying an asset greater than $3 or $4 million, this makes a lot of sense. What you do is you hire a third-party tax company to do a study on the property called a cost segregation study. And that allows you to accelerate the tax depreciation and take bonus depreciation, essentially front-loading the tax depreciation on the asset. So for example, the building we just purchased in Passaic, New Jersey with our investors, let's say you came in with a $100,000 investment. On your K-1 tax form you're going to receive in March from us for your 2024 investment into this building, you're going to get about $30,000 of tax depreciation on that $100,000 investment, because we had a cost segregation study done and we front loaded all that tax depreciation, and now we can distribute that bonus depreciation out to our investors. Now, that doesn't mean you lost $30,000 on your investment. It's a paper write-off. It's a paper tax deduction. That means you now have $30,000 in passive tax write-offs that you can write off other passive gains on, or keep it in your back pocket to write off the cash flow that's going to be earned on the property over the next 4 to 5 years. So the bottom line is, talk to your CPA, but tax depreciation generally utilized through real estate and utilizing the tools such as a cost segregation study allow you to just take full advantage of the tax code and legally keep more of your money and pay less taxes, which I'll tell you, it's even feels better than it sounds when you actually do it. So I love at the end of the year not owing the IRS money, but putting money in my pocket through my assets. And I'm able to do that because of the way I pay myself, not through a W-2 income, not through business income necessarily, although there's a small amount there, but primarily through the refinance of assets and the cash flow of assets that's then written off through tax depreciation. Okay, why we all make money mistakes. And so I explained a big mistake I made investing in cryptocurrency, right? I broke my cardinal rule, right? Here I am teaching investment master classes. I shouldn't make mistakes with my money. That's ridiculous. It's hypocritical. Now, we all make mistakes investing. Quite frankly, if you're not making mistakes, then maybe you're not investing, aggressively enough, or you're not investing at all, right? So part of the business is sometime making mistakes. And so why do we make mistakes? Well, fear of missing out. The reason I invested in those silly altcoins, not knowing what I was investing in and losing money ultimately, was because all my friends were making a lot of money in cryptocurrency. Now, don't get me wrong, I still own a Bitcoin. Our company owns a Bitcoin. We bought it at 30. I think it's up to 100. It's probably one of the best investments we ever made. So I'm all about crypto investing. I'm all about smart investing. I think Bitcoin actually, in the long term, is a solid investment. I wouldn't get in right now necessarily, but I think it's going to dip in the future. They say 4-year cycles. But that's neither here nor there. The bottom line is fear of missing out, FOMO, is a powerful tool. It's why we do a lot of things in this world. And you always want to check yourself when you're investing. Are you doing it because of FOMO? Because you fear this opportunity won't be here tomorrow. Now, most good investment opportunities, real estate, and being one of them, but really any good investment opportunity generally isn't around for the longest time. Because if it's really a good opportunity, you actually have to move pretty quick on it. In our business, we move very fast on great opportunities. So you don't want to mistake taking action on a good opportunity for FOMO. But, always recognize, are you doing something just because you heard your friends are making money doing it? You really want to dig into it further than that, because sometimes your friends might not be the best people to go to for investment advice. In fact, they most likely aren't. Self-control, right? Overspending and developing a lifestyle that we cannot keep up with. It's really interesting. We work with a lot of high net worth individuals, and there are times where it's incredible how tight they can be on their cash, earning $500,000, $600,000 a year, but still having trouble paying for all the expenses of having kids and a big house and vacation homes and vacations and faster cars and more luxury automobiles. There's a limit to it, right? In fact, I read an article that earning over something like $85,000 a year, the amount of happiness as it correlates with your income just dilutes and dilutes and dilutes. So there's, I think in New Jersey, you got to earn more than that, but there's a limit, generally over $250,000 a year, are you that much happier? No, I mean, it's really all about having, a controllable lifestyle, having self-control. And for our high earners out there, I encourage you to always look at your spending and continue to invest and allocate as much as you can to your investments, without over allocating, of course, to investments. But keep an eye on your spending because, money out just to our lifestyle costs is money we never get back. But investments is money that not only you get back, but you multiply that dollar as well. So it's important to understand the difference and make sure you're putting more into investments than on your lifestyle costs. Bad advice. We trust the people we hire for advice, but sometimes they can be wrong or mislead us. A little typo there and wrong. And or intentionally or unintentionally. So this is important here. Most of the time, poor financial advice is unintentional. it's something that, an investment advisor thinks this is a great stock pick or something like that. It's just a mistake. We all make mistakes, right? Even investment advisors. So, but keep in mind there are people that intentionally mislead you as well, right? We've heard stories of those in the news. So again, another reason to work with great professionals who are experienced, who have a good track record, whether it's uh, a real estate investment opportunity or a registered investment advisor or a wealth manager or your estate attorney. You want to work with trusted professionals in the space. And often a referral is the best way to get those. So talk to people that you admire financially and say, who do you use for your investments? Who do you use for your estate planning? Try them out. If you don't get a good feeling with them, or they're too expensive or something like that, then reach out to us. We do know good wealth advisors. We know good RIAs, and we know good estate planners as well. We are not in that business at all. We're strictly focused on buying great real estate deals and making our investors consistent returns through their real estate investments. But we know RIAs and wealth managers in the space because we work. Sometimes we'll share clients in that space. They'll suggest clients to us and vice versa. So here's a little bit more about People's Capital Group, and then we'll wrap up here. Again, I encourage any questions in the chat or the Q&A. So we just acquired a 42 unit asset in Passaic, New Jersey. Our in-house property management team is busy repositioning that building right now, renovating units, improving the management. There's a bunch of trash in the backyard. We're cleaning that out. A bunch of trash in the basement. We're going to make laundry down there and storage units. So our plan for 2025 is to refinance 2 or 3 assets that we've bought over the last 5 years that are ripe now and stabilized and ready for refinance. And that'll create nice liquidity events for our investors. And we'll raise another $10 to $20 million and ideally acquire a $20 to $40 million asset or a few assets. We're actually launching a $30 million fund in Q2 of 2025. So we're in the midst of formulating that right now, working with we're interviewing managing broker dealers and RIAs, and we're talking with different consultants in the space, family offices, equity firms, and determining the best route to raise this $30 million over the next year. In 2026, we plan to raise about 25 million and acquire about 50 million in assets. 27, we'll bump that up to 50 million and ideally acquire about 100 million in assets. And 28 to 29, we'll begin harvesting those assets, exiting them through refinance and sale. We plan to refinance these assets about 3 to 4 years in upon stabilization and then sell at the end of year 5, creating liquidity events for investors and cash flow along the way as well. Here's the core team. That's me, Aaron Fragnino on the left. Seth Martinez there next to me. So I focus more on education, working with investors, client relations. I have about 170 podcast episodes called the Passive Cash Flow Podcast. You can check that out on Spotify and Apple iTunes and YouTube, all the major platforms. Our website as well, peoplescapitalgroup.com. And I also focus on the updates to investors, the financials, and you'll probably be talking to me if you're considering partnering up with People's Capital Group here and building our wealth together. So I work with all of our investors and make sure they're kept abreast of how their investments are operating and what's coming up as well. There's Seth. He's more on the operations end. Seth makes sure the trains run on time. He's managing our management company. He's managing our insurance brokers, making sure we have the right insurance. He's making sure our contractors are doing the right renovations for the right costs. He's reviewing the estimates there. Seth is so more on the operations end. He also manages our debt fund, which buys smaller properties, single family homes and smaller multis and lots of land. And we'll flip those for quick income into the company, where I'm more on the equity side, buying larger assets and raising capital from family offices and high net worth individuals for equity investments, which are about 5-year investments. Now, we get paid on the back end for those. All the returns go to the investors up front for those equity investments. So the debt fund keeps quick revenue coming into the company, where the equity investments are more the long-term strategy for the company and for our investors as well. The investors that invest in the debt fund earn an interest rate of 8 to 11% and hold a promissory note. That's a fit for a lot of investors. That's that fixed return, right? That's for older investors that want a fixed return. right? And like the idea of knowing exactly what's coming in, when it's coming in, how much they're going to make and when they're going to make it. No volatility. Where the equity investments are better, perhaps for younger investors, more below the age of 65 that are looking to multiply their wealth more aggressively. Those returns tend to be between 14 to 20% IRR. So you're going to do better in equity investments ideally, but there's more volatility, a little more risk, where debt position allows you to earn a consistent interest payment, but overall the return targets are lower, but it's a fixed return. Lena Delgado, she manages our property management company. Lena works her butt off. She's managing our leasing staff, making sure our contractors are getting the renovations done on time. She has a staff under her to focus on rent collections, lease renewals, and all the challenges of property management, which are just too many to number. Dana Sargenti makes sure our ACH deposits go out on time, right to our investors' account. Make sure our financials are done properly. Very busy time of year for her. We just went over our financials on our properties here, our quarterly financials for Q4 of 2024, which we'll be sending out tomorrow to investors. That's a profit and loss sheet. That's a balance sheet as well. And that's a profit and loss statement, a balance sheet, and a distribution sheet also. So our investors are kept abreast of the in-depth financials of their assets here at PCG. We also work with so many contractors. We have about 4 to 8 crews working at any given time. Leasing agents as well. A big part of managing real estate the right way is leasing to the right people, putting in the right tenant off the bat. Don't just accept the first application you get, but vet your applicants well. Take your time leasing units out. Now, we do lease our units rather quickly because we line up tenants beforehand. That's one benefit of having multiple units in a property. You can kind of show one, line up a number of tenants, and then accept one for that and move the second best one over to the other unit as it becomes available. So you kind of have your tenants lined up. But we also work with content specialists, over 170 podcast episodes, educational videos on our YouTube channel, dozens of webinars and masterclasses. So check them out at peoplescapitalgroup.com. You can check us out on YouTube as well. You just put People's Capital Group and we should pop up there. IT professionals, we have a client portal that our investors log into. They can see how their investments are doing. They can also access their monthly updates that are emailed to them, their quarterly financials, and their K-1 tax forms that are distributed on an annual basis to our investors. That's all in the investor portal. So you log right in, you see how your investments are doing, kind of similar to like having an Ameritrade account or something like that. But instead of owning stocks, you're owning real estate. Virtual assistants help make sure everything's running properly on the back end. 1031 intermediaries and tax specialists. We do accept 1031 capital. If you want to learn more about that, schedule a call with me, Aaron Fragito. I can go over the strategy there and how we work with 1031 capital. We work with the CPA firm for the last 10 years. They're great on doing the tax prep for a very good price and also at a quality work as well, and getting that out to our investors in a timely manner. So we get you your K-1 tax forms before March 15th. And attorneys skilled in all different facets. Now, you want to make sure you use the right attorney for the right job, right? We have closing attorneys that are really experienced at closing on real estate, but some are good at residential real estate. Others are good at commercial real estate. Then we have tenant landlord negotiation, right? If you're filing an eviction on a tenant, you want to use a completely different attorney for that. So you have attorneys that are specialized in tenant landlord law. Then you have SEC attorneys that draft our PPM, our private placement memorandum, and our investment documents to make sure we're SEC compliant and our investors are protected with making their investment as well. And we even have attorneys that are focused on affordable housing. We own some affordable housing where you want to have specialists in that. So you want to make sure you work with the right expert for the right task, whether it's investing, managing your investments, or of course, law as well. Property and due diligence, acquisition experts. We have an incredible underwriting team that underwrites our opportunities. We'll look at 400 deals sometimes to buy one. So a lot of underwriting goes into finding the right deal. Real estate specialists, realtors that bring us deals, appraisers, the whole 9 yards. So lenders, to make sure that we have the right due diligence done on our assets, and we're also closing with the best deals for the best price, finding off-market deals through wholesalers and realtors, pocket listings as well. So thank you to all our investors. We are only as successful as our investors. We have over 100 people that invest with us here at People's Capital Group. About 83% of them reinvest after a liquidity event. And we would not be succeeding if it weren't for our loyal investor base. So thank you to all the people that invest with us, some on our webinar here, others that, of course, watch the recording of these masterclasses as well. Here's what we're working on right now. We just closed on this asset in December. This is a 42-unit apartment building in Passaic, New Jersey. It's targeting a 19% internal rate of return and 1.9x equity multiple to investors. The minimum investment on this is $50,000, and this is a 5-year investment. This is limited to accredited investors only. I'll go through what that is in the last slide here. Here's an example of a $100,000 investment amount. Starts off slow as we reposition the asset, but we do target cash flow from Q1 on this property. In fact, we're distributing some interest payments to investors tomorrow on this building. And starts off with about 2.6% in the first year in cash flow. Then we're targeting a little over 4% in the second year through cash flow, then up to about 9% by year 3 as we reposition the asset, improve the units, increase the revenue on the building by renovating the units and implementing amenities as well, laundry in the basement, storage, a nice backyard area to walk the dog or have a barbecue. And then we go to refinance the very beginning of year 4, where we target about 80% return of investors' capital upon the refinance beginning of year 4. That's that tax-deferred liquidity event I spoke of earlier in the presentation. Then year 5, we plan to sell the asset and continue to cash flow through year 4 and 5, kind like 5% a year or so in cash flow. And so there'll be 2 large liquidity events, one at the beginning of year 4 and one at the end of year 5. Those are our targets, and cash flow along the way as well. Rents are 30% below market value. A lot of work to do on the value add side. Desirable location, 55 minutes to New York City. Off-market deal we bought way below market value. We were the only bidder on the property. That's how you get deals at a good price. When you get in there quickly, you know the broker, you get there before any other bidders, you get your offer accepted before other bidders can come in on the property, before it's marketed out to even anyone else. That's how we snag this for a great price. Totally mismanaged, trash in the backyard, not taking advantage of all the amenity space in the building, no amenities. So we're going to clean out the trash in the basement, put in laundry and storage and so on, and can ideally produce cash flow from Q1 to investors, and of course complete that refinance by month 37, ideally returning about 80% of investors' capital. So we purchased this in December of 2024. We have 13% of the capital available for this. We've raised 87% of the capital. We don't need all the money up front. We have about a $1.1 million CapEx budget, renovation budget for this property. We have about $600,000 sitting in an account ready to go to renovate the asset. So we don't necessarily need to raise all of our capital up front for the building, but we do have this opportunity open to investors. We're not actively emailing it out or texting it out or posting it on social media, but this is the raise we're finishing off at this time. We do expect to finish off this raise over the next 30 to 60 days. So if you are an accredited investor, which by the way is an individual with an income of $200,000 a year or a household income, including your spouse, of $300,000 per year, or a net worth of $1 million, not including your primary residence. Okay, that's an accredited investor. Okay, once again, income of $200,000 annually or $300,000, including your spouse, or okay, it's any one of these 3. $1 million net worth, not including your primary residence. If you meet any of those categories, you would ideally be an accredited investor, which would qualify you to participate in this opportunity. If you're not an accredited investor, you may be a sophisticated investor. You may qualify for our debt fund where the minimum investment is $30,000, and those are 1 to 3 year investments earning 8 to 11% interest. This opportunity, the minimum is $50,000. You do have to be accredited. It will probably be filled up in the next 30 to 60 days. I'm actually going to be pitching at the Pitch Slam at the Best Ever Conference in Salt Lake City. We were selected to pitch at that event, and this is going to be the deal I'm going to pitch. So hopefully there's room in it when I do the pitch, but there'll be about 1,000 investors in the room, and I do expect to fill up this little bit very quickly there at that event. So ideally you want to get in touch with us pretty quickly, get qualified, complete the qualification process, fill out the e-docs, and complete the investment over the next couple weeks, because the pitch is going to happen the very first couple days of March. And at that point, we expect the final spots to fill up. So I'm going to put a link in the chat to schedule a call with me, Aaron Fragnito. Okay. That's the first step in getting qualified to invest with us here at People's Capital Group. And once you are qualified as an accredited investor, at that point, you'll be able to get access to our investor portal and schedule and complete your investment right on the investor portal. So I'm going to put this in the chat here, and then we'll open up for questions.